Let's talk about something that's making a big return in retirement planning. You might have heard the term before, perhaps even dismissed it as a bit old-fashioned. But under current market conditions, annuities are becoming an increasingly attractive option for securing a reliable income in retirement, especially here in the UK. This resurgence is clearly reflected in recent figures. In 2024, UK annuity sales experienced a significant increase, with a 24% rise in the number of contracts sold and a 34% increase in total sales value compared to 2023, making a new 10-year high for annuity sales, reaching £7 billion. So if you're looking to understand what an annuity is and how it can benefit you, and why they're suddenly back in vogue, stick around. We'll break down the different types, explain the crucial link between gilt yields and annuity rates, and even show you how inflation plays a fascinating role in your annuity income rates. In simple terms, an annuity is a financial product that you purchase, usually with a lump sum of money from your pension pot, in exchange for a guaranteed income for the rest of your life or for a set period. Think of it as exchanging a chunk of your savings for a regular, predictable salary in retirement. Let's imagine Sarah, age 65, has a pension pot of £150,000. She's worried about market volatility and wants to secure income for life. She could use £150,000 to purchase an annuity. Let's say, for simplicity, this buys her an income of £7,000 per year for the rest of her life. Sarah now knows that no matter what happens, she has that £7,000 coming in every year. This certainty allows her to plan her retirement spending with confidence. Now, why should retirees care? Well, for many, the biggest worry in retirement is outliving their savings, the fear of running out of money. This is where annuities truly shine. They offer guaranteed income. This is the big one. Unlike drawing down from your pension pot, where you manage the investments and the withdrawals yourself, an annuity removes that investment risk. You know exactly how much income you'll receive, come rain or shine, market crash or boom. This provides incredible peace of mind. Longevity protection. With people living longer, annuities provide a safeguard against the risk of living beyond your expected lifespan. No matter how long you live, your annuity income continues. Simplicity. Once you've set it up, an annuity is relatively hands-off. You don't need to worry about managing investments or making withdrawal decisions. The income simply arrives in your bank account. Annuities aren't a one-size-fits-all product. There are different types designed to meet varying needs and preferences. Understanding these differences is key to choosing the right option for you. Let's break down the main ones. Level annuity. This is the most straightforward type. You receive a fixed income that stays the same for the entire duration of the annuity, whether that's for life or a set period. The benefit here is predictability. You know exactly what you're going to get each year. However, the downside is that inflation will erode the purchasing power of your income over time. What feels like a good income today might buy you less in 10 or 20 years. RPI annuity. This type of annuity aims to combat the effects of inflation. Your income will increase each year in line with the Retail Price Index, or RPI, which is a common measure of inflation in the UK. This offers greater long-term purchasing power. However, because the insurer is taking on the inflation risk, the initial income you receive from an RPI annuity will be lower than that of a level annuity for the same premium. It's a trade-off. Lower starting income for future inflation protection. LPI annuity. Similar to RPI annuities, LPI annuities also provide inflation protection, but with a cap on the annual increase. This cap is often set at a specific percentage, for example 3 or 5%. LPI annuities offer a middle ground. They provide some protection against inflation, but the cap means that if inflation skyrockets, your income won't keep pace fully. Because of the cap, the initial income offered will typically be higher than an RPI annuity, but lower than a level annuity. Short-term annuity. Unlike the for-life annuities, the short-term annuity pays an income for a fixed period, typically between 5 and 10 years. After this period, your pension pot is not exhausted, and you would need to decide what to do with the remaining funds. Perhaps purchase another annuity, go into drawdown, or take it as a lump sum. These can be useful for those who want a guaranteed income for a specific period, perhaps to bridge a gap until your state pension kicks in, or if you're unsure about your long-term plans. They offer flexibility, but you need to be mindful of what happens at the end of the term. The choice between these types depends on your priorities. Do you value a higher initial income and are comfortable with the risk of inflation eroding its value over time? Or do you prefer a lower starting income, but with the security of inflation protection? Now, let's talk about something crucial that's been driving the recent resurgence in annuity popularity: gilt yield rates. You might be asking yourself, what are gilt yields and what do they have to do with my retirement? Well, surprisingly, they have a significant impact on what you can expect from an annuity. Gilt yields are essentially the interest rates on UK government bonds, what the government pays to borrow money. When gilt yields rise, annuity rates tend to rise too. Why? Because annuity providers invest the money you pay for your annuity into assets like gilts to generate the income they promise to pay you. When gilt yields are high, insurers can generate a better return on their investments, meaning they can offer you a more attractive income for your money. Conversely, when gilt yields are low, annuity rates tend to be lower. We've seen a significant increase in gilt yields over the past year or so, largely due to rising interest rates as the Bank of England tackles inflation. This is fantastic news for anyone considering an annuity. This direct correlation is why annuities are looking so much more appealing right now. If you're nearing retirement, or even if you're a few years away, keeping an eye on gilt yields is a smart move. Higher yields often translate into more generous annuity offers. This is where it gets really interesting when comparing level annuities with inflation-linked annuities. On a like-for-like premium basis, a level annuity will always provide a higher starting income than an inflation-linked annuity, like RPI or LPI. This makes sense, as the insurer isn't taking on the risk of future inflation increases with a level annuity. However, the magic of compounding and inflation comes into play with indexed annuities. While your initial income is lower, it increases each year. Over time, that cumulative increase means that at a certain point in the future, the income from your indexed annuity will overtake the income from a level annuity and continue to grow, providing you with greater purchasing power. Let's illustrate this with an example. In this scenario, Sarah, age 65, decides to go with option A, a level annuity receiving $6,000 per year. Her friend John, also 65, goes with option B, the RPI annuity, initially receiving $4,500 per year. Let's assume an average inflation rate of 3% per year. In year 1, Sarah receives $6,000, John receives $4,500. In year 5, Sarah still gets $6,000. John's income has increased to approximately £5,065. In year 12, Sarah's income is $6,000. John's income has now reached approximately $6,220. At this point, John's annual income has now overtaken Sarah's. In year 20, Sarah's income is still $6,000. John's has surged to approximately £7,845. His income is now significantly higher and continues to grow, providing greater purchasing power. This crossover point is crucial. For John, even though he started with less, his income began to provide more purchasing power in the long run. The real game changer is this: the higher the inflation rate, the earlier that crossover point will be reached. If inflation were to average 5% instead of 3%, John's income would grow even faster, and he'd overtake Sarah's level income at an even younger age. This is why, in periods of higher inflation, indexed annuities become even more compelling. They offer a powerful antidote to the erosion of your purchasing power over time. While the immediate gratification of a higher initial income from a level annuity is tempting, for those with a longer life expectancy or a greater concern about future living costs, an indexed annuity can prove to be a much more financially robust option in the long run. Annuities, often overlooked in the past, are experiencing a renaissance. Current high gilt yields are making them a genuinely attractive option for securing a guaranteed income in retirement. While they offer predictability and protection, it's vital to understand the different types and impact of inflation and whether their characteristics align with your personal retirement strategy. Remember, your retirement is unique, and so too should be your financial plan. Take the time to understand all your options, get professional advice, and make the choice that gives you the peace of mind and financial security you deserve. If you found this information helpful, please give this video a thumbs up to let us know. Subscribe to our channel for more straightforward financial guidance and hit that notification bell so you don't miss any of our future content as we continue to demystify the world of personal finance. Do you have any burning questions or specific topics you'd like us to explore in future videos? Don't hesitate to drop a comment below or get in touch with us using the link conveniently placed in the description. Also, be sure to navigate over to the Xenia Learning page, which we've linked in the description box for you. There, you'll discover further reading materials that delve deeper into these topics, as well as a full transcript of today's video, allowing you to revisit any of the key points we've covered at your own pace. Finally, and this is crucial, always seek professional financial advice that's specifically tailored to your unique personal situation before making any significant retirement decisions. Remember, every financial journey is different, and a qualified professional can help guide you in the right direction for your individual needs and aspirations. Until our next voyage together, plan smart, steer wisely, and prosper on your retirement journey.